dispose of a property. Well, that provides tremendous amount of information. It's not just that bottom line number. I mean, you as a business person kind of look at that bottom line number. Am I getting money or am I having to pay money? But all the information above that is necessary information to provide and let you know exactly what that property did at the closing. So when you record a HUD-1 statement, you either do it one of two ways. You either do it right, or you just record the bottom line number. And that's okay. It doesn't tell you everything you need to know, but at least the accountant, when he does the tax return or is doing some financial work for you, can tie that to a HUD-1 and then do a journal entry to record all the background data. If you don't understand how to record a HUD-1, don't do it. You can have your accountant teach you how to do it, but you're best served if you don't exactly understand how do I record this. You're going to go in there and record just that. I received $1,526.02. You're going to record that as one number. And you can put a little memo in there, say, see HUD-1 closing date, 11/25, whatever, so that your accountant can track that back to the HUD-1. I would advise you, because the business that you are in, the real estate business, can be complex accounting. And I would advise you to at least make contact or have at your disposal a good accountant that can help you through some of the traps in that so that you get good information. If you keep good QuickBooks, you can see at a glance what that entity is doing. I mean, it gives you all kinds of good information. Honestly, in real estate, operating out of your hip pocket is a tough thing to do, because you have to have a really good memory to know what this property is doing versus this property, because you may have cash in the bank, but that doesn't mean that you're making money, especially when you have wraps and you have payments coming in and you got payments going out. At any given time, you might have some money, but your obligations are such that you may not have any money at a later date. Let's see. Let's talk about entities for a minute, and I'm going to combine that with methods of accounting. The simplest form of business is just a sole proprietorship. That's filed on Schedule C. And if you have rents and royalties, it's just a rent schedule called Schedule E. Now, I am a big proponent in keeping it simple, but this is not always the best situation for you as a taxpayer, citizen, okay? Because there are some tax laws that you can take advantage of to reduce that expense of the taxation that you have. So many of you are familiar with LLCs. An LLC, Limited Liability Corporation, is just a simplified corporation. I'm not going to give you law advice or legal advice, but I'm going to tell you based on my experience, this is what I understand. It protects you in some cases if it's done right, if it is done right. And I'll say that again, if it is done right. An LLC can protect you against a claim against something that, some act or some property that is contained within that LLC against possibly some of your other assets. And that's why people do that, is that they have a rent property, and then there's other tax reasons that you might want an LLC, but the major reason is liability. It's trying to structure your liability so that you've got it in different places so that it doesn't come back to you personally. But again, I want to emphasize if it is done right, because what an attorney wants to do is they want to pierce, it's called piercing the corporate veil, and get to you as an owner personally. And if you don't do it right, they can possibly achieve that goal. Just because you have an LLC and you have this nice little book that says here you're incorporated by the state of Texas, doesn't mean that you necessarily have limited liability. If you use that LLC and you pay all your bills out of there, you get the money from the rents and you pay your own personal utility and you pay your dog food and you pay your daughter's school program, whatever, to that LLC, and the attorney says, you know, you never ever treated this as a separate entity, then he could possibly persuade somebody, the judge or a jury, that you may have set up this really neat little LLC, but you ignored it, and consequently, it really doesn't exist as far as this case goes, Your Honor. Because I can show you, Your Honor, that this person never treated it as a separate entity. And when you treat something as a separate entity, you do it this way, in general. You are the owner over here of the property. It's just like, in some cases, owning shares of General Motors. Okay? You as the shareholder then elect, just like General Motors shareholders elect, you elect a board of directors. Now, in most small entities, they're one and the same. You wear the shareholder hat, you wear the director hat. Then, as the board of directors, you then hire somebody. You hire the chief executive, the treasurer, the secretary of the entity. And in most cases, this guy over here, the shareholder, and this guy that is the director, and this guy that is the chief executive officer are one and the same. Well, if you do that properly, it's okay. You can be all three of those things if you document that properly. Good books and records are very important in LLC. So we want limited liability, so we have